Have you ever dreamt about being a millionaire? I bet you have. The stock market is one of the fastest, easiest, and smartest ways to double your money. If you pay attention and play your cards right, you could be on your road to riches. The stock market has been around for a very long time, over 400 years, and people invest more money than you may think. Just take a look at this statistic from Financial Samurai. As of 2021, the top 10% of Americans owned an average of $969,000 in stocks. The next 40% owned $132,000 on average, and for the bottom half of families, it was just under $54,000. Even the lowest is as much as a brand new car in full. That's a lot, especially for the lower and middle class who don't have the money to risk. They invest this money for a reason, though. My name is Aaliyah Mahoney, and today I want to show you why. In the next 4 to 5 minutes, I will show you the basics on how to invest in the stock market. According to expert writers Ariel O'Shea and Chris Davis, there are 5 main points to focus on when beginning to invest in the stock market. First, decide how you want to invest. Second, choose an investing account. Third, know the difference between stocks and mutual funds. Fourth, set a budget for your stock investment. And fifth, focus on the long term. Step 1. Decide how you want to invest. There are 3 main ways to do this. First is an online broker such as TD Ameritrade, which is what I personally use, Robinhood, or E-Trade. An online broker is an intermediary between a buyer and seller of a financial instrument. They typically work online, but do also sometimes work over the phone. Their main job is to help facilitate for commission. The second way you can invest is with traditional investment advisors. They are investment professionals who will work closely with you to create and manage your portfolio. As a new investor, you'll more than likely not go this route, as traditional investment advisors typically work with bigger clients who have been in the stock market for a while and have much bigger portfolios, usually with at least $500,000 invested in them. The final way that you can invest is with robo-advisors. This is the most common route for most new investors, as robo-advisors can do just about anything a traditional investment advisor can do, but for half the cost. Big investors typically don't use robo-advisors simply for the fact that they have too much money already invested, and it being a computer rather than a person, they just feel a little bit more reliable using the traditional investment advisors. But they are a great option for beginning investors. After you've chosen how to invest, your next step is to choose an investing account. There are different options as I have listed here, but your best choice as a beginner would be a standard brokerage account or a non-retirement account. It provides access to a broad range of investments, including stocks, bonds, mutual funds, exchange-traded funds, and more. Any interest or dividends you earn on investments, as well as any gains on investments that you sell, are subject to taxes the year that you receive. This is by far the best choice for a beginner investor, especially if you plan to invest for the long term, which most people do. It's not only the best for beginners because of its broad variety of investments that you can put money into, but also there are no withdrawal fees and no restriction on the dollar amount that you can invest. Expert investors recommend a standard brokerage account over any other for brand new investors. Your next step will be to know the difference between stocks and mutual funds. This step is crucial considering that these are 2 very different kinds of investments. Stocks are an investment in a single company, while mutual funds are a fund that you put money into that can hold potentially hundreds of stocks in one single fund. Stocks are much better if you want to take the time to create your own portfolio and look deeper into each company that you're putting your money into, while mutual funds are a great way to just put money into multiple and have your hands on different kinds of stocks very easily, especially if you don't care as much about what companies you're putting it into. One is not necessarily better than the other, it is just a matter of preference. Your 4th step is to set a budget for your investment. A really great way to do this, which I have learned from personal experience, is to make the investment a priority rather than just throwing in a few dollars here and there. Set aside a certain amount each month as you would for bills, insurance, groceries. In order to do this, you will need to shift your budget around. A great place to pull is from the extras that you don't really need to spend money on. Say you wanted to go on a shopping spree or put money into your new favorite video game or go out to dinner. You still can. Just pull a small amount from each one of those totals that you would have had and make that your stock budget. Fixing your budget shouldn't mean eliminating the things that you love, just taking a small bit from them, as they wouldn't do any help to your future most of the time, and putting this money into stocks, and over time you won't even notice that it's gone and it will build and grow. This is a great way to start, and as you get more comfortable and knowledgeable in stocks, you may find other ways to up your budget. But this is a great place to begin. Your fifth and final step is to focus on the long term. When investing in stocks, you need to forget about that money and let it sit for a very long time. It can take years to even see a large profit. Pulling too early is not usually your best choice. Even when things crash, typically they will go back up and sometimes even higher than they were to begin with. According to Sean Williams, a team member at Ultralong, buying stocks for the long term allows you to take advantage of compounding or the ability to reinvest your profits or dividends over time to generate even greater profit potential. Time is your best friend as an investor, and being able to reinvest a dividend at 3% can make a difference in your wealth come retirement. As an example, simply pocketing a 3% yield will double your money about every 33 years, assuming no dividend or stock price growth. If reinvested back into more shares of the same stock, your investment would double in almost 10 or fewer years. Another great example of this would be Bitcoin. When people first invested in Bitcoin, they bought shares for a very low price. Most people pulled too early and made only a small amount of profit, but the smart investors held through the dips and the ups and the dips again and made millions of dollars. It was unknown then, but is now the biggest cryptocurrency in the world. Before I conclude, I wanted to share a bonus slide with you of a few stocks that are projected to get very big in the next few years so that you have somewhere to start. You have cryptocurrencies such as Dogecoin or Ethereum, marijuana companies because marijuana is becoming very legalized, anything in AI, artificial intelligence, which is taking over the world. These are some of the biggest stocks that are projected to grow in the next few years and get very big. As you can see, the stock market is a great and easy way to make money if you learn how. If you follow the 5 main steps that I discussed in the last few minutes, which to recap are 1, decide how you want to invest, 2, choose an investing account, 3, know the difference between stocks and mutual funds, 4, set a budget for your stock investment, and 5, focus on the long term, then you should be set. This is one of the smartest ways to double your money. Have a happy, smart, fun, and time investing, everybody.